An update of the U.S. economy relative to the PMI index that's published once a month at the start of every month. And we're using the ISM version, even though there's another version done by Market Economics. Okay, I'm Rich Possum for Critical Point. It is January 5th, 2022. And what I want to point out, this is an annual chart of the PMI rating that comes out every month. And so the annual chart shows us the start of the month, the lowest and highest of the month, and then of the year, and then the closing of the year. So each one of these candles or bars is a year. There's a 9-year business cycle. It's actually 8 to 13 years. It's also called the juggler macroeconomic cycle that you can look up online. It's well known in various economic circles. Even the Federal Reserve is probably aware of this. Okay? And inside of that 9-year cycle is a series of about 4 to 6 of 3 to 4 year cycles that are probably very similar to the economic cycle or business cycle called Kitchen. And you can look that up online too. It's Kitchin. And it was discovered in business inventory. But we've learned there's a similar cycle in all types of business statistics and economic statistics for the economy. We even learned that cycle is in climate. It's even in stock markets and commodity prices, just different definitions of it and different characteristics of it. At any rate, we've had a forecast that the PMI has been very strong coming out of the pandemic recession, and that's actually normal behavior, okay? And the PMI should now erode and calm down till near the end of this decade, when near the end of this decade it could drop to 45 or lower, which would be a sign of a recession. In the meantime, a drop below 50 would be a sign the economy is slipping backwards relative to manufacturing and probably services, but it would not be a sign of a recession. And even if it were to drop to 45 or lower, it would probably only be a secondary recession, not what I would call a true or primary recession, unless that 9-year or juggler business cycle is in its down phase. Then you're going to have a recession. Then that would make sense to have a rating of 45 or lower. So my conclusion is that it looks as though unemployment will continue to decline, employment continue to increase, unemployment rate should be about 3.9, 3.8 sometime this year. I think in coming years it's 3.5 to 3. We might even, towards the end of the decade, see record low unemployment. We're going to get full employment, okay? Now, the thing is, it takes time, and the stock market is just going to continue to rally all during that time. It's not going to worry over that employment situation that much. We should not get a surge of unemployment to near the end of the decade when this cycle is going to roll over. So this means any bounce in unemployment or other negativity behavior in business statistics could very well just be a scare. It's nothing more than the market or the economy throttling up, throttling down, but basically on a path of growth, okay? And so the PMIs can deceive us in that they could erode here for several years, making us think, oh, the economy's slowing down. No, the economy's not slowing down. It's just growing at a slower pace. When it drops below 50, the economy's not only slowing down, it's starting to move backwards, okay? And at 45, it's actually going backwards. You're losing, the economy is in recession, okay? So it will be normal behavior to pull back, and what we know that there are 3 to 4 year pops and drops in this PMI indicator that has been shown to correlate very well, positive correlation, to GDP, nominal GDP per capita, various percent rates and whatnot. So yes, it does mean GDP can back off along with PMI, but we're going to have a positive GDP for quite some time. The overall value, volume, size of our economy will continue to move to record large numbers, size, however you want to look at it, for coming years. So drops in the PMI may lead to scares. Someday you may see it below 50, but if it's not time for that primary recession, for that juggler business cycle to turn down, if the stock market goes lower along with that lower PMI, it's probably a buy the dip opportunity that eventually PMI is just going to pop back above 50, okay? So we think there's a 3-year cycle, or LT3 according to our models on the pricing side, that's pulling down now but it's not necessarily time to cause any problems for the stock market. So don't be surprised PMI works lower into next year and then rebounds a bit and then works lower, a zigzagging type of structure, and it does pull back. The economy is going to continue to move forward. Now this chart is what I call the econ or economy trend indicator. And all I'm doing is taking the PMI and saying if it's below 50, subtract it from the prior month. If it's 50, do nothing. And if it's above 50, add it to the prior month. And I was amazed when I stumbled into this. It eliminates most of the smaller fluctuation during a year, even during a decade, and shows us that 9-year business cycle. It shows us the juggler business cycle. This was a recession and a bottom and into recession, economic boom in the 2000s, financial crisis, a super cycle recession actually, and then we go right back to economic growth, even longer economic growth than the 2000s, and then we have the pandemic recession right on time. It's almost like the markets and economies just simply said, if we can't come up with our own business reason to have a recession, then let's bring in nature and let nature cause a problem for us so we get it. It's just fascinating how it worked. We were due for it. We got it. We got something different story, that it was triggered by a virus, all right? But the point is we got the recession at work. Now we're in the economic growth phase, and you can see how long in the past, this is the shortest we should have for economic growth. This is about the longest we should have for economic growth. The trend is solid, and even though the PMIs may erode as long as they're over 50, it's just going to keep adding to this indicator, keep driving this indicator higher and higher and higher. This was a secondary recession in here, primarily due to manufacturing commodities, not the entire economy. It slid under the radar screen. Most economists didn't even know it occurred, okay? This was just some fear and fluctuations pulling out of the financial crisis. And in 2012, there was even consumer indicators. I think Bank of America Merrill Lynch had an indicator that showed retail stock investors and consumers were more bearish in 2020 or 2012, more negative, pessimistic than they were even in the financial crisis. And they were wrong. The economy just kept on growing, and the stock market just kept on marching higher, and people missed out of billions of dollars that could have gone into retirement if they hadn't been so worried about what was going on in the economy and the politics, and if they hadn't been, and if they'd had a better understanding of how the economy really works in terms of business cycles. If you understand this, it's extremely important. In my opinion, this trend is higher into late this decade. We'll look for some problems about mid-decade, but likely higher into late to the end of this decade. I think the stock market is going to perform along with it. So as of the report of December 2021 for the PMIs, it's all constructive. It's all positive. 2 thumbs up for economic growth for some time. No signs of complications, but don't be surprised to hearing some throttling down, throttling up along the way. But basically, the economy continues to grow. Past results not necessarily indicative of future results. Check us out at criticalpoint.podbean.com and also criticalpointpod.com. Thank you.